Welcome to this episode of Hidden Money. This is episode 6 of our real estate series, and I and Kevin are so excited to talk to you about something called opportunity zones. It's not a new term. It was new in 2017, but it's a bigger and better term after the One Big Beautiful Bill Act passed earlier this year.
Yep. And these opportunity zones are an opportunity.
A huge opportunity.
For tax purposes, for deferring and even eliminating. Very few times in the tax code can you actually eliminate tax. Typically it's a deferment game. Yep. But we are going to be able to eliminate taxes in real estate using opportunity zones.
So if you hear a CPA or a tax advisor or a podcaster stating something like, you can only defer taxes, you can never eliminate the recognition of taxes, that's bull honky. And here's one way you can do it without having to die to eliminate it. So opportunity zones were originally part of the Tax Cut and Jobs Act of 2017, and they were very wonky. They came out with this artificial date of 2026. The basics were, and we don't need to get too much into the basics of the old law because the new law is much better. But the old law said, hey, if you invest in an opportunity zone, and what we're going to do is we're going to create all these opportunity zones throughout the country. And the point of this is to try to incentivize investments in economically distressed areas. And when you hear that, don't think, oh, bad investment, because some of these economically distressed areas are incredible investment places. But the point was to try to get people to buy and build businesses or improve businesses inside economically distressed areas. So when they originally came out with it, though, it was a brand new part of the tax law. We had to wait 2 years. It was until 2019 that we started getting final regulations from the Treasury Department on, which was almost already too late, because what it said is, hey, if you have a gain that you would have to pay tax on this year, we'll give you 180 days to invest it in a qualified opportunity zone fund, which was invested in a qualified opportunity zone. If you do that, we will let you defer recognizing any tax on that gain or any income and paying tax on that gain for 7 years. But you'd have to do it 7 years before December 31st, 2026. And these rules didn't come out till 2019, so you already were out of time. But they said if you held it for 7 years, then you'd only have to recognize 85% of the gain after 7 years. Or if you held it for 5 years, so that ended in 2021, if you held it for 5 years, you could defer 10% of the gain permanently and then recognize the rest. That's just one part. The next part is, if this is an opportunity zone and you meet all the qualifications, once you have to say you buy a business for $1 million, you deferred that gain for $1 million. I'm generalizing here, but let's say you buy it for $1 million, you defer that gain for 5 years, 7 years, you recognize part of that gain. Let's say 25 years later, you sell that business or that real estate business for $10 million.
Big gain.
Big gain. Tax-free, completely tax-free.
If you get into an opportunity zone. So these opportunity zones, it's a census done. Is it a census? I think it's a
census tract
data that your local jurisdiction does, or is it congressman?
No, so
the House or
the
something?
States, Congress is allowing all the states, their governors or assemblies, they get to decide in the state who does this.
Yeah.
To designate up to a certain amount of opportunity zones in their state. And they have to meet 3 different qualifications. I'm not getting the detail, but basically that census tract that they're designating has to meet one of these 3 criteria. One of them is the average salary or the average annual income of the people that live in that census tract are 70%, it used to be 70, it used to be 80, now it's 70. Are 70%, their average income is 70% of what the average income is for the metro area or that state. So what could be poor, or considered poor in an opportunity zone in New York, might not make it in Louisiana. So they're all over the place. Right now we have almost 9,000 opportunity zones. They changed the rules, made it a little harder to qualify this year under this new rule. And they're coming out with new opportunity zones. It's either June 30th or July 30th of 2026, next year. And we expect there to be about 7,000. And this law was made permanent now. It doesn't expire in 9 years like the last one does. It's permanent. And every decade, the states are allowed to designate more opportunity zones.
Yeah, and one area that we constantly bring up is Broken Bow. Just because Broken Bow, Oklahoma, the population there generally, don't be offended if you're listening to Broken Bow, generally, according to the census data, the population there that lives there has lower income. But the people in Broken Bow who live there are driving the income down, but there's a very strong short-term rental market in Broken Bow.
Crazy strong.
Properties in the millions. So you're having $1 million high-end properties in Broken Bow that are in opportunity zone. So that's kind of the opportunities, hence the word opportunities, that you could find is I could take my gain from another asset or another business sale that I'm recognizing. I can move that gain into this opportunity zone, and this isn't like a 1031. This is an actual fund that you create a partnership, and this is the work that we do behind the scenes, but we would walk you through all the creation of the fund. Yeah. But that gain is not going to be paid tax on for 5 years at all.
And after 5 years, you're only going to pay 90% of that gain? Or this new thing that came out this year, only 70% of the gain. Get a 30% permanent deferral with the qualified rural opportunity zone, a new term created in the bill, the One Big Beautiful Bill Act. Let me back up for a second, though. So back when the opportunity zones were first created in 2017, most people didn't understand them. And
there's a new concept. There's nothing like it in tax law.
We didn't understand it. We were looking for guidance from the Treasury.
You got to create a fund, you're deferring, but you're recognizing.
You got to
there's
file
a whole
these
period,
forms.
and
yeah.
It was very hard.
But there were some funds. There were a lot of funds that popped up and said, we are a qualified opportunity zone fund. Invest with us, defer your gains. The cool thing is like unlike a 1031, you got 180 days. You can collect the money and then decide within 180 days later to put it in an opportunity zone fund. But a lot of these funds popped up, and I've seen more people, and maybe there's some good operating funds out there that made money, but I don't think I've met a client that has made money on a qualified opportunity zone fund established by some big company. But you don't have to invest in a big fund. You can create your own fund. I kind of hate that part. I thought they were going to fix that. Like, why should I have to create a fund if I'm investing in a business or creating a business and opportunity zone? That's dumb. Yeah. I thought they'd fix it, but they didn't. Yeah. But you can create your own fund.
And don't be scared about the term fund, because it's not like you're registering with the SEC and all this kind of stuff. It is literally a husband and wife can go into business together, create a partnership, create a fund, and then we file all the fair market value valuation paperwork inside that partnership. We get everything lined up inside the partnership. That partnership is the fund. Then it kicks off a K-1 to your personal tax return. Yeah. So even let's say you are a family-owned business, husband-wife owned business, you sell your business, you can still stay in business together and buy a rental property, defer that gain, eliminate pieces of it, then we can cost segregate that property even more. So you're not paying tax on the sale. Then we can cost segregate at full fair market value or do a purchase price allocation. And you could do both. You could double dip. You can defer the gain, eliminate a piece of it, but also tax plan with that.
You're actually triple dipping, because not only are you deferring the gain, you'd be creating tax benefits today, maybe eliminating your taxable income that year. And then if you hold that property for 10 years or more, you sell it, it's tax free. So I'd say that's triple.
Get into that a little bit more, because there's some hurdles in there that we need to kind of go over a little bit.
Good
because
point. It's not as simple
as just buying and holding this Broken Bow property for 10 years and then selling it.
Yeah.
There has to be some work. So if you think about this from the government standpoint, they're trying to find distressed areas, quote unquote distressed low income areas. They want to incentivize. Remember, the Internal Revenue Code's an incentive-based system. We preach on this all the time. There's chock full of incentives in the Internal Revenue Code. This is one of them. They want to incentivize outside money, investors, to invest into these quote-unquote distressed areas and improve them, not just buy and just sit on a property. You have to improve the property to a certain extent, and then if you're improving the property, making it better, hence making the community better, property taxes are going up. You can see kind of the government's move here is they're incentivizing you to go into these areas and make them better for living conditions. And then if you hold on to that property for the set amount of years, you've improved the property a set amount. I think it's double the basis
Well, I'll get into that. It's
Yeah.
double or half the basis depending on what kind of
if it's rural.
opportunities
Yeah.
are, right?
So if you buy a $1 million property and it's not the rural purchase, it's just a short-term rental in Broken Bow. I'm just going to keep using Broken Bow just because.
Although it might qualify as a rural in Broken Bow, but we won't know until next year anyways.
Yeah, when the maps come out.
Yeah.
So at that point, if you buy $1 million property, you have to improve that property, double its basis over the 10-year period.
No, in 18 months. You have
I thought it was
18
10
months to
years.
double the basis.
Oh, okay. I hope you're enjoying this episode of the Hidden Money Podcast. I just wanted to bring to your attention that we have an amazing tax firm, that we practice what we preach on this podcast. It's Revo Taxpayer Advocacy. You can Google us or just go to revotaxpayer.com. When you go there, you can schedule a free consultation with either Mike or I. We want to personally talk to you and get to know you and see if we can't just get back as much tax dollars in your pocket as possible. So revotaxpayer.com. All right, back to the episode.
But think of this. You go buy a raw lot in Broken Bow, $300,000. You build a house, $300,000 in 18 months.
There you go.
Boom, you've done it. You can put, let's do it, 500 and 500, right? To make it easy math for me, because I'm not the numbers guy like you are. So you go buy, let's say you have $1 million gain that you want to defer. I know a lot of people right now, they're enjoying highs in the stock market, but they want to diversify. I was just talking to a client the other day who has $5 million of Microsoft stock that he got in at like 40 bucks. And he wants to diversify out of it, but he doesn't want to pay all that tax. But he doesn't want to be all in that gain. Take $1 million, sell $1 million of gain of the stock. Get out of the market, diversify. Create an opportunity zone fund, put your $1 million in it within 180 days, go out and buy a $500,000 lot, build a $500,000 house on it within 18 months, and you don't pay any taxes on that gain for 5 years. And then either you pay taxes on 90% of it if it's not considered a qualified rural opportunity zone, or you pay 70% of the taxes you would pay if it is after 5 years. Hold on to it. So you've got $1 million in this property. Hold on to it for 10 years and turn around and sell it for $3 million. Now you have $2 million of gain, tax-free for life.
That's great. And the appreciation doesn't scare you on the property.
No.
Now you have $1 million property. You hold on to it for 10, 15, 20 years. It's probably worth $2.5, $3 million maybe, depending on that area.
Yep.
Maybe $1.5 million, who knows? But you can sell that rental property tax-free.
Absolutely.
It's nothing like it in the Internal Revenue Code. And
It does have a limit though. You're only allowed to shelter or increase your basis over a 30-year period. So after if you hold on a property for 30 years, let's say you don't sell it for 40 years, after 30 years, that's what your new basis is. You can't keep getting a fair market value increase. So let's say you buy this $1 million property, 30 years from now it's worth $10 million, and then you sell it in 40 years for 15. Well, now you're gonna have a $5 million taxable gain, but you've sheltered $9 million, man.
yeah, that's great.
That is awesome.
It is really cool. And to find these opportunity zones, what I do is I just go to Google and I type in opportunity zone map. There's going to be a .gov website at the very front of your search. You can actually go into it, make sure it's a .gov, and you go into there and you can put in zip codes, you can put in addresses. So let's say you do have a large business gain this year and you're like, well, I kind of want to get into real estate. 1031 exchange does not work if you're selling a property, or not a property, but a business. Let's say we sell our CPA firm. I can't 1031 my CPA firm into real estate.
Because they're not like kind.
It's not like kind. It has to be real estate to real estate and this similar industries. So we can't do that. But in an opportunity zone, it's almost like a backdoor 1031 in this instance, is because I could take my gain from selling my business, put it into this opportunity zone and not pay tax. So go to the map and make sure that before you do your next rental purchase, check the map.
You'd be shocked. Like, there's coastal areas. I was just looking with a client last week at South Padre Island. There's a place right off of there that's a census tract that qualifies. And if it's a qualified rural opportunity zone, and the way it's defined in the One Big Beautiful Bill Act is anywhere in an area that has an average or has a population less than 50,000, which I suspect South Padre will. I suspect Broken Bow will. We'll see. Then you only have to improve or increase your basis by 50% over the next 18 months. So you buy a $750,000 property, you only have to improve it by $375,000. Man,
That's great.
this is exciting stuff.
Yeah, and even let's say you didn't do the raw land and it's hard to improve the basis. You can always add a pool. And now I don't know if that needs to make business sense.
Yes.
So, but we also want to make sure we stay in this opportunity zone the correct way. So you can add a wing to the property. You're increasing the value. You can add a bedroom. You can add a guest suite. You can add some landscape, some backyard remodel. Stuff gets expensive. So make sure you have the available capital to improve the property and you're not just thinking short term, okay, I got my money into a fund and I bought the property. Step 2, I do have to improve the property a set amount depending on if it's rural or not.
So when you're looking at a property, first of all, when you have a gain to shelter, look at the gain and determine, am I buying a rural opportunity zone or regular opportunity zone? But you put all the money in the fund within 180 days of experiencing that gain. Then you go find the property and just make sure you're doing the math. If you're in a normal opportunity zone, only use half the money to buy the property and have the other half available to use in the next 18 months.
Yeah,
and it doesn't have to be real estate. You can go buy a dry cleaner, a car wash. Go buy a car wash that's not being used, that could be used a lot if it had newer and improved equipment, but it's run down and it's a perfect location. It's not automated. Go buy one of those and put in all new equipment in it and be printing out cash, offset your income. Another cool thing though is you don't have to use gain money, right? So let's say we don't, and it has to be capital gain. You can't take a gain like your W-2 income and shelter for 5 years. It has to be capital gain or capital gain type gains that you're deferring. But let's just say we don't have any gains this year, and Kevin and I have a stand-up year. Between the two of us, we make $500,000 this year, and we want to go buy a short-term rental. We can go do that in Broken Bow. We're not offsetting taxes this year, or in one of these other opportunity zones. We're not offsetting taxes, but as long as, again, we improve the property within 18 months, as required, hold on to it for 10 years, sell it tax-free.
We're not deferring money into it, but we're getting the back end, the exit tax advantage by selling our property tax-free.
Absolutely. So it just shows that axiom where they say, the only constant in life is death and taxes. Taxes ain't constant. You just need a better tax advisor.
That's right. That's 100% true. That's 100% true. Well, that's opportunity zones. Do you have any? I think we hit on it from a very high level.
I mean, there's so many details and specifics you need to go into. I'll just add a few more details. They did make in this One Big Beautiful Bill Act, they made it a little more complicated to do the reporting on these. So don't just go willy-nilly and buy an opportunity zone and think you're fine. Find someone that knows the rules or come work with us, because you got to create the opportunity zone fund before you contribute the capital into it or go buy the property. That has to be done. Every year you have a special self-certification and report you have to file with that return. The reason for that, I kind of like it. I don't like the additional complexity, but they're trying to prove, Congress who created this opportunity zone, this is not just a tax shelter. This is actually to help improve economically distressed areas. So they're having you report things like the increase in fair market value, the amount of business you did, and you're reporting it to one of the federal government bureaus, not the labor statistics, one of them they're having to report it to, and they're required starting in 2031, that agency, to give a report and show how much and how well this is working. Can you believe that? Yeah. Accountability for a tax plan or a tax law in our government? Incredible.
So, nothing like it. There's nothing like a qualified opportunity zone. It's very cool. And you get to still, like we said earlier, you still get to take advantage of purchase price allocations or cost seg. So even if you had some ordinary income or some W-2 income, but you had some gain that were sheltered, we could do both.
Yep.
And so
I'm just going to give two examples of two different clients I've spoken to in the last 2 months where this made perfect sense and they're getting the best of three worlds, right? So one example, there's a client we had that bought a bunch of Tesla stock when it was low. They are no longer politically aligned with Elon Musk, so they want to sell their Tesla stock. And they have. They sold it when they thought it was at the high. They have 180 days to do this opportunity zone thing. They're going to be able to, and it was a lot of money, man. I'm talking more than a few million that he sold. That's a lot of money. So we're working together. Hopefully we're going to get this opportunity zone created. He still hasn't made his mind, but if he does this is what we're going to do. We're going to take that $3 million plus bucks, put it in the opportunity zone fund, buy the property, and you actually can extend it longer. You don't have to buy the property within 180 days. You got to create the fund. There are similar rules, but we don't exactly know what they are yet. Like, you probably should have an identified property and a couple replacements just in case. That's how they follow the rules. But go find the property. And what he's thinking is storage, self-storage. So go buy this land. And he actually thinks he already might have a piece of land in a trust in his family. He can buy it from the trust. He'll have to do a certified appraisal so there's no self-dealing going on. And then build the storage units. Boom, he's just avoided paying taxes on $3 million of capital gain for 5 years.
And he's moved into real estate, an investment he no longer was aligned with, now into a controlled asset that he can manage and
Absolutely.
manage himself.
And then, again, the whole period he sells it for tax-free. His family is doing quite well. But he didn't do anything to eliminate additional income this year. He just deferred his gain this year. So another client, similar deal, a bunch of RSUs vested, a few $1 million. They're recognizing in income this year. And we were able to get the E3B file, and it's capital gain. So he's got this capital gain. He's trying to do it with a vacation rental and bust butt to improve it in the same year, which is going to be hard, but I think he can do it. It's going to be hard. But if he does that, now he was able to offset his W-2 income this year, defer the recognition of his capital gain for 5 years, and then again turn around and sell it. So it's just, there's so many different ways you could do this. And you don't have to do it by yourself. You don't have to have a husband and wife. You can have one person create a fund by creating an LLC and a limited partnership. And their LLC is the GP of their limited partnership. You can have a group of people do this. I think, Kevin, you and I need to do an opportunity zone.
Yeah, and we're going to be helping. We help all of our clients with the actual form filing, the partnership fund filing. We handle all of that. So go to revotaxpayer.com, click on schedule a consultation, and Mike and I would love to speak to you about the potential of doing an opportunity zone. So thank you for tuning into this episode. We'll catch you next week.